Welcome to the research desk.
Glad to be here.
So I want you to imagine it is early 2023. You are looking at your portfolio and your macroeconomic models are just flashing bright red.
Right, every indicator is screaming that a recession is imminent.
Exactly. Interest rates are climbing rapidly. Inflation is lingering. And the models tell you that technology stocks are massively overpriced. So you mechanically rotate your capital into safe, cheap, defensive sectors. You do exactly what the textbook says.
And then you sit back and watch as technology absolutely skyrockets.
Yeah, it rips higher with unprecedented velocity, leaving you entirely behind. You basically miss out on one of the greatest wealth-generating years in modern history, all because a regime model told you to play it safe.
It was a brutal wake-up call for a lot of quantitative managers.
In that exact central paradox of current financial markets. It is a structural tension that forces every serious capital allocator to rethink how they manage risk.
Because the traditional rules seem broken, right?
Well, yes and no. On one hand, macroeconomic stress still punishes economically sensitive, cyclical sectors with ruthless, unyielding speed. The traditional penalty for holding the wrong assets going into an economic slowdown it's as severe as it has ever been.
But on the other hand, we have these massive structural anomalies.
Right. Structural winners, specifically technology and mega-cap compounders, possess the capacity to snap back so violently that relying on a rigid traditional sector rotation strategy has basically become a career-ending mistake.
Which leads to the core question we have to answer today.
Exactly. Should sector allocation work like trading gold against oil, mechanically owning what hedges the regime and buying what is historically cheap?
That is the trillion-dollar question. I'll lay out my position first. My stance is that sector leadership remains deeply and inextricably regime-sensitive. I'm going to argue that a dynamic, regime-aware overlay captures market-implied risk appetite significantly faster than official, backward-looking economic data.
Okay, so you're still defending the traditional spread models.
Absolutely. By observing where institutional capital is flowing in real time, investors can protect their portfolios when it matters most. You avoid the devastating drawdowns that accompany a cyclical collapse. We don't need perfect macroeconomic foresight if we are listening to the price signals the market is already broadcasting. Well, I approach this from an entirely different perspective. I mean, the elegance of those rotation schemes is deeply seductive when you draw them up on a whiteboard.
But
they frequently fail in the friction of the real world. My position is that cheap alone is not a viable strategy. Treating structural compounders as if they are cyclical trading vehicles leads to vast underperformance and, frankly, catastrophic value traps.
So you think mean reversion is dead?
I think markets are not neat, mean-reverting machines. If you try to mechanically rotate out of secular growth stories merely because a regime model tells you to buy a historically cheap defensive sector, you are going to systematically underweight the greatest wealth-generating assets in the modern economy.
Okay, to unpack this, I think we need to begin by establishing exactly how the collective referendum on risk actually functions. We need to do that before we introduce the real-world frictions you are talking about.
Fair enough. Let's define the terms.
Let's look at the defensive-cyclical spread. For the listener, we're talking about the performance gap between safe, boring companies like utilities or consumer staples that sell toothpaste and groceries, and highly economically sensitive companies like industrials or financials.
The classic risk-on versus risk-off barometers.
Right. I view this spread not as a theoretical academic construct, but as behavioral truth. Investors managing billions of dollars do not sit on their hands waiting for the Bureau of Economic Analysis to release a revised GDP print.
No, they certainly do not. They have to move ahead of the data.
Exactly. They don't wait for the Institute for Supply Management to publish delayed purchasing managers' indices or PMIs. They move capital. When sectors like utilities, consumer staples, and healthcare begin materially outperforming industrials, consumer discretionary, and financials, that is the market actively repricing fragility in real time.
You're calling it a live referendum on risk tolerance.
That's exactly what it is. And historically, this real-time voting mechanism has been early enough to save investors from catastrophic loss. Look at the data from the first quarter of 2008.
The global financial crisis.
Right. The mainstream narrative often pretends the market was caught completely unaware by the global financial crisis. People act as if lightning just struck out of a clear blue sky when Lehman Brothers collapsed in September.
When in reality, the warning signs were flashing for months.
The actual market data tells a completely different story. In that first quarter of 2008, institutional money was already moving aggressively. Utilities gained roughly 9.5%.
Wow.
Yeah. And in that exact same window, financials plummeted more than 20%. The defensive-cyclical spread pushed decisively into risk-off territory months before the September collapse.
So the signal triggered well before the actual panic.
Exactly. You didn't need to predict the exact date the credit markets would freeze. You didn't need a doctorate in subprime mortgage contagion to know something was profoundly broken.
The price action was doing the talking for you.
The signal only had to reveal that capital was fleeing economically sensitive sectors before the broader index fully reflected the danger. Think of the defensive cyclical spread as a weather forecast.
Okay, I like that analogy. Go on.
You dress for the day based on the forecast. You don't need the meteorologist to predict the precise path, velocity, and timing of every single gust of wind. If the spread tells you a storm is gathering, you put on a coat.
Meaning you reduce your cyclical exposure.
Exactly. You reduce your exposure to cyclical drawdowns and you size your risk appropriately for worsening environment.
Well, I challenge the underlying assumption there. I really do. Because you're selectively focusing on prolonged, orderly deteriorations where the market kindly gives you a 6-month warning.
You don't think the 2008 signal's representative?
I question the utility of this spread in event-driven shocks. Yes, the spread behaves as an early coincident indicator during a slow-moving credit crisis like 2008, where the subprime rot took over a year to fully infect the system. But in sudden shocks, the spread is disastrously late.
Sudden shocks are always hard to price, though.
True, but let's examine the late 2018 trade war escalations. We saw rapid, news-driven sell-offs cascade across the entire market before any clean, orderly macroeconomic regime shift was visible in sector leadership.
So the broad market dropped before the rotation happened.
Exactly. By the time the defensive sectors established a clear statistical trend of outperformance, the damage to the broader portfolio had already been done. The model was effectively telling you to buy a fire extinguisher while standing in the ashes of your house.
That's a strong image. But wasn't 2018 a policy anomaly?
Early 2020 was an even harsher reality check for this methodology. The COVID-19 shock produced indiscriminate selling and violent, unexpected cross-sector correlations. The regime shift was entirely too abrupt for any neat, threshold-based mathematical system to process.
Well, everything correlated to one during the COVID crash.
Right. A defensive cyclical spread hovering near zero beforehand would have offered absolutely no preparation for a nearly 34% S&P 500 drawdown that occurred from late February to late March.
It was an unprecedented exogenous shock, to be fair.
But that's my point. In these event-driven episodes, the spread merely describes the stress after it has already begun. It acts as a historian, not a prophet. Knowing the tide is going out is fine for medium-term allocation on a calm day.
But not in a tsunami.
Precisely. If you are facing a tsunami, directional knowledge of the tide will not save you. The water recedes, and seconds later, the wave destroys the beach.
So you're saying the historical reliability of the signal is overstated?
I'm saying a signal can look incredibly compelling on a historical chart, but if it fails to protect capital before the drop in a high-velocity shock, its practical value for an active manager is severely compromised.
Okay, I hear you. But expecting a single indicator to predict a black swan event like a global pandemic is demanding an impossible standard of perfection.
I'm not asking for perfection, just practical utility.
But stripping macroeconomic complexity down to a parsimonious, tradable regime indicator is vastly superior to waiting for what I call the movie director's cut of macro data.
The director's cut.
Yeah, you don't need to wait for the final, polished release of every single economic report to understand the plot of the market's emotional arc. If the model protects you in the structural, slow-moving drawdowns, which represent the vast majority of wealth-destructive bear markets historically, its failure to predict a once-in-a-century pandemic does not invalidate its utility.
I suppose that depends on how much you value protecting against tail risks versus structural risks.
Exactly. Okay, so if top-down macro timing is too blunt in a sudden shock, as you argue, What happens when we look at the individual parts? Does buying what is historically cheap save us, or is that just another trap?
This naturally leads us to how relative valuation attempts to solve the limitations of broad allocation.
Right. This is where the quadrant framework of cheap hedge versus cheap growth becomes essential. For the listener, a cheap sector is only genuinely attractive when viewed through a regime filter.
Because cheap can often just mean broken.
Exactly. During an economic boom, not every cyclical sector deserves your capital. Some are cheap for a reason. During an economic slowdown, not every defensive sector is worth paying a premium multiple for. The quadrants attempt to narrow the vast field of the stock market down to plausible opportunities based on the intersection of valuation and the macroeconomic environment.
Okay, walk me through an example where this actually worked.
The reopening trade of late 2020 into mid-2021 provides a flawless execution of this exact framework. By October 2020, as the market anticipated vaccine rollouts and a return to economic normalization, technology had already re-rated aggressively to premium multiples.
Right, everyone was piling into the work-from-home trade.
Everyone wanted the software companies that thrived during lockdowns. However, industrials were trading at a massive discount relative to their own history and the broad market. Let's look at Caterpillar as the definitive case study.
A classic cyclical heavy industrial.
Exactly. In October 2020, Caterpillar sat at roughly $160 to $170 a share. It looked incredibly inexpensive relative to its cyclical recovery potential.
And what did the dynamic model suggest?
It signaled a massive opportunity. By mid-2021, Caterpillar ripped above $240, delivering a gain of more than 40% in less than a year.
A huge move for a legacy industrial.
And the underlying nature of Caterpillar's business didn't fundamentally change over those few months. They still built heavy machinery. What happened was a regime change paired with a valuation reset.
Meaning the market finally recognized the impending recovery.
Right. Mean reversion kicked in. The tendency for an asset's price to return to its long-term historical average. The dynamic overlay perfectly identified a cheap cyclical asset poised for a massive macroeconomic tailwind.
Okay, I understand the Caterpillar example, but I want to dismantle the allure of cheapness itself, because mechanical quadrant thinking frequently leads investors directly into a value trap.
You think Caterpillar was an exception, not the rule?
You are highlighting Caterpillar, which was a genuinely healthy business temporarily suppressed by a global pandemic. But the fundamental danger of your framework is how easily fundamental decay disguises itself as a cyclical opportunity.
So you're talking about structural decline masquerading as cyclical weakness.
Precisely. Let me detail the catastrophe of General Electric in 2017 and 2018. On the surface, if you were running a mechanical valuation screen looking for cheap assets in a supposedly favorable quadrant, General Electric looked like the ultimate cheap legacy industrial.
It definitely showed up on a lot of contrarian value screens back then.
It was temptingly priced for contrarians. It was trading on compressed valuation metrics that signaled a massive buying opportunity, if you believed in the mean reversion.
But it didn't revert.
No, it did not, because the cheapness was not an anomaly. It was an incredibly accurate reflection of severe underlying deterioration. To be clear on the mechanics here, the company was suffering from declining return on invested capital.
Meaning they were destroying shareholder value with every new project?
Exactly. For every dollar they pumped into their operations, they were generating less and less actual cash back. They had immense debt stress and rapidly shrinking free cash flow.
And the stock paid the price.
The stock collapsed from around $25 in early 2017 to below $10 by late 2018. This is where treating assets merely as statistical inputs requires rigorous scrutiny.
Because the model couldn't see the debt load?
A sector or a stock can score as deeply undervalued while the business itself is structurally dying. Think of it through a clinical diagnostics analogy.
Okay, let's hear it.
In medicine, a biomarker might show statistical significance in a published academic paper. But if that biomarker lacks clinical specificity, meaning it flags that there is an abnormality, but it cannot distinguish between a benign condition and a terminal illness, it is clinically useless to the physician.
It doesn't actually change the treatment plan.
Right. It does not change the doctor's treatment plan. Furthermore, buying a cheap sector without a fundamental structural catalyst is like applying an outdated diagnostic tool to a completely new disease.
The tool tells you the patient is cheap, but it fundamentally misunderstands the pathology of why they are cheap.
Exactly! Cheapness is not a catalyst for price appreciation. Sometimes cheapness is merely evidence of the crime. There is a famous anecdote on Wall Street about a speculative market for trading tins of sardines.
Oh, I think I know this one.
A trader buys a tin of sardines for an exorbitant price, thinking it's a great investment. Later, he gets hungry and decides to open the tin and eat them. He immediately gets violently ill.
Right. And he goes back to the broker.
He complains to the broker who sold him the tin, and the broker says, "You don't understand, those sardines are for trading, not for eating."
A classic.
If you treat a structural compounder, or conversely a structurally dying business, purely as a trading sardine, something you buy and sell based on nothing but the momentum of its price relative to a historical average, you are entirely ignoring the underlying reality of the asset.
Let's test that assumption. If valuation is simply a trap for dying industries, and tracking these spreads is as flawed as you suggest, how do we explain the persistent, overwhelming academic evidence that dynamic asset rotation beats static holdings over long horizons?
Are you talking about the long-term backtests?
Yes. We cannot simply dismiss the framework because value traps like General Electric exist. We have to look at the definitive, long-term statistical reality of how markets actually function. The hard data from 2000 to 2023 regarding the defensive cyclical spread is unambiguous.
Unambiguous is a strong word.
But it's true. It measures exactly what it claims to measure. Let me walk you through the math. When the defensive cyclical spread is greater than plus 5%, meaning defensive sectors are materially outperforming the market over a rolling period, the S&P 500 averages a negative 2.8% quarterly return.
So the broad market is actively losing money?
Exactly. In that exact same environment, defensive sectors generate a positive 0.7% return, protecting your capital, while cyclical sectors suffer a negative 5.1% return. The spread gives you the warning, and the capital preservation follows.
Okay, and on the flip side?
Conversely, when the spread is below negative 5%, indicating a strong risk-on environment where cyclical sectors are leading, the S&P 500 averages a positive 4.5% return. Cyclicals soar to a positive 6.8% average return, while defensives lag at a positive 2.1%.
It paints a very neat picture.
The mathematical reality of these regime thresholds is impossible to ignore. It is a verifiable map of market behavior. And this is not a phenomenon isolated to the last 2 decades. We have multi-century research backing this up.
You're bringing in the Baltussen research?
Yes, Baltussen's research spanning 220 years of data proves that dynamic trend following combined with asset rotation consistently beats static hedges, like simply holding gold or buying put options.
200 years is a lot of data.
And it's not the only study. Bouye and Teiletche examined 50 years of market history and proved that dynamic frameworks adapting to 4 distinct macroeconomic regimes, Goldilocks, overheating, stagflation, and downturn, outperform traditional static strategic asset allocation.
So the academics agree with you.
The empirical evidence across centuries insists that risk compensation is time-varying. The amount you get paid to take a risk changes depending on the environment, and portfolios must dynamically rotate to capture those changing premia.
I see the appeal of those centuries of back-tested data. I really do. But theoretical outperformance rarely translates into practical alpha, and we need to examine why.
You think the friction is too high to capture those returns?
Exactly. You are presenting gross, theoretical returns that exist in a frictionless academic vacuum. I will counter your multi-century backtests with a single, devastating data point from the source material regarding practical implementation.
Okay, let's hear the data point.
Pure contrarian sector rotation produced a 0.53 Sharpe ratio over the long term compared to a 1.00 Sharpe ratio for simply buying and holding the broad market SPY ETF.
That is a significant drop in risk-adjusted performance.
For the listener, let's contextualize what a Sharpe ratio actually tells us. It measures your return compared to the amount of turbulence or risk you had to endure to achieve that return.
So a higher number is better.
Right. A Sharpe ratio of 1.00 means you are getting a solid unit of return for your unit of risk. A Sharpe of 0.53 means you are taking on massive volatility and trading complexity for a fraction of the payoff compared to just sitting quietly in the S&P 500.
That's a stark comparison.
That massive underperformance is not a rounding error. It is a mathematical indictment of the entire strategy. It reveals the severe implementation friction inherent in dynamic overlays. Think of this through a supply chain bottleneck analogy.
Okay, how does the supply chain analogy fit here?
The supply chain of your rotation strategy consists of data acquisition, signal processing, market execution, and continuous feedback. Theoretical alpha bleeds out at every single link in that chain.
Because of transaction costs mostly?
You suffer transaction costs every time your model tells you to swap sectors. You suffer immense tax drag if you're not operating in a tax-advantaged account because you are constantly resetting your capital gains.
The tax drag alone can destroy a strategy's edge.
Exactly. And you suffer the cost of crossing the bid-ask spread on sector ETFs. And most critically, you suffer evaporating liquidity precisely during the stress periods when your model tells you to aggressively rotate.
When you need to move the most capital, it's the most expensive to do so.
When the market is panicking, the cost to execute these elegant regime shifts skyrockets. The 0.53 Sharpe ratio proves that a strategy can be directionally correct on a spreadsheet and still lose to a simple broad market index once the friction of the real world is applied.
Those are very real mechanical frictions, I can't deny that.
But beyond the mechanical friction, there is a profound philosophical wildcard that quantitative models completely ignore. I'm talking about the cultural confidence spread.
The cultural confidence spread, explain that.
Defensive cyclical spreads are not culturally or geographically neutral barometers of macroeconomic data. They fundamentally measure collective faith in institutions and future policy responses.
That's an interesting way to frame it.
Look at the contrast between the West and China immediately following the 2008 financial crisis. In the West, institutional investors fled aggressively into traditional defensive sectors out of a genuine existential fear that the global financial architecture was breaking permanently.
Right, they bought utilities and staples because they thought the banking system might literally cease to exist.
China, however, reacted entirely differently to the exact same global macroeconomic signals. Because the Chinese public and institutional investors trusted the state's massive infrastructure stimulus response, their market did not exhibit this same desperate mechanical rotation into defensives.
So the underlying cultural trust overrode the macro signal.
The underlying confidence in the state's willingness to step in and stabilize growth altered how the concepts of defensive and cyclical were perceived and traded. You can extrapolate this to Japan's lost decades as well.
How so?
Beginning in the 1990s, Japan suffered a persistent generational deflationary psychology. Their eroded belief in future economic growth meant that defensive signals fired continuously for years on end.
But that rotation was driven by a deep cultural sentiment of pessimism.
Exactly. It wasn't just a tidy macroeconomic threshold crossing a 5% boundary. Spreads measure faith just as much as they measure fundamentals.
I acknowledge the severe friction inherent in transaction costs. And your point regarding institutional trust is deeply insightful. It is true that spreads capture the psychology of systemic faith.
It complicates the pure quantitative model significantly.
It does. But this raises a vital question for anyone managing capital today. If the framework requires institutional trust and near-perfect execution to overcome the tax and transaction friction, does that mean we abandon the concept of regime protection altogether?
That is the dilemma.
Or does it mean the market has fundamentally recategorized what safety actually is?
And I think we both know where this is leading.
This brings us to the absolute climax of this tension, the brutal, clarifying sequence of 2022 and 2023. This 2-year window served as the ultimate real-world stress test, and it ultimately shattered traditional anti-tech rotation logic.
It broke a lot of models.
Let's set the stage with the 2022 validation. 2022 was a brutally difficult year for equities, but it was structurally perfectly aligned with regime theory. The S&P 500 fell roughly 19% as the Federal Reserve tightened monetary policy aggressively to fight inflation.
The end of the zero interest rate era?
To be clear on what duration sensitivity means in equities, When interest rates go up rapidly, the present value of future cash flows goes down.
which crushes growth stocks.
Consequently, long-duration growth companies, particularly speculative technology equities that promised profits a decade in the future, were systematically decimated. However, regime-aware rotation functioned perfectly.
The traditional safe havens worked.
Energy surged. Traditional defensives like utilities and consumer staples materially outperformed the broader index. The defensive-cyclical spread widened, the signals flashed red, and the models protected capital precisely as they were designed to do.
The quants took a massive victory lap.
Capital allocators utilizing traditional mechanical regime models took a massive victory lap. The system worked. They protected their clients from the tech crash.
But that exact victory lap led those same investors directly into the 2023 annihilation.
It was a brutal reversal.
In 2023, the macroeconomic picture shifted only slightly. Interest rates stabilized, but they certainly did not return to the zero-bound environment of the previous decade. Yet, artificial intelligence enthusiasm exploded.
The generative AI boom caught everyone off guard.
Technology and communication services seized market leadership back with unprecedented violent force. Anyone who is clinging to mechanical anti-tech rotation, anyone who is waiting for historically cheap cyclical sectors to experience mean reversion, was punished severely.
Because the models told them to stay defensive.
The models that saved them in 2022 forced them to completely miss the historic wealth generation of 2023. By treating technology as a high-beta cyclical asset that should be sold during macroeconomic uncertainty, they locked in their underperformance.
And this forces us to dissect exactly why this happened, leading us to the structural winner revelation. The core lesson of the 2023 Whipsaw is that equity sectors are no longer stable, homogeneous categories.
Technology isn't what it used to be.
Technology is no longer purely a high-beta cyclical sector as it was in the dot-com bubble of the year 2000, where companies were trading purely on eyeballs and hype. Today, technology possesses utility-like stickiness.
Utility-like stickiness. Expand on that.
Let's explain that mechanism. Cloud infrastructure, enterprise software, and mission-critical digital platforms have become non-discretionary expenses for global corporations.
They can't just turn them off to save money?
Exactly. A major corporation does not turn off its Amazon Web Services cloud servers or cancel its Microsoft enterprise software licenses just because GDP ticks down 0.1%. Those services operate with the baseline reliability of a utility bill, yet they retain long-duration sensitivity and massive growth upside.
They are essentially the modern electricity grid.
That's a perfect way to put it. Consider the killer statistic underlying this entire debate. Technology delivered roughly a positive 3.9% annual structural outperformance for an entire decade.
Exactly. And that positive 3.9% annual outperformance is the graveyard of simplistic mean reversion.
Because you can't bet against that kind of structural advantage forever.
If you cannot repeatedly underweight a sector that possesses superior operating margins, capital-light economics, and massive secular demand tailwinds, merely because a historical price-to-earnings ratio says it is expensive.
The historical PE ratio is just an average, after all.
If you treat a structural compounder like a trading sardine, you will be, as the data shows, valuation aware all the way into severe underperformance. The 2023 reversal proves that expensive sectors can remain expensive and even expand their multiples further, because high returns on invested capital and durable earnings growth entirely justify those persistent premiums.
So cheap is not always good, and expensive is not always bad.
If a company generates massive free cash flow without needing to build multi-billion-dollar physical factories, it fundamentally deserves a higher multiple than a heavy industrial company.
The destruction of rigid mechanical rotation in 2023 forces a reconciliation between our two perspectives. How do we invest tomorrow based on these opposing yet undeniable truths?
It's a delicate balancing act.
We know the spread works mathematically over centuries to identify risk, but we also know that blindly selling structural compounders because they look expensive is financial suicide. We must synthesize this by flipping the framework entirely.
Flipping it how?
The defensive-cyclical spread is not a standalone alpha engine designed to tell you precisely what to buy aggressively. Rather, it is a sophisticated risk management tool telling you how much risk not to take.
I think that is the most critical distinction we've made today.
This requires strict, actionable portfolio rules. The anchor rule is paramount. Keep the SPY, a broad market index, as the strategic core allocation of the portfolio. We must use rotation strictly at the margins rather than attempting wholesale all-in portfolio swaps.
I entirely agree with setting that boundary condition. The evidence overwhelmingly supports dynamic tilts as a marginal overlay, not as a replacement for owning structural earnings leadership.
Let's lay out the explicit mandates, delivered as precise operational rules for managing capital in this environment.
Go ahead.
First, treat the spread as a traffic light, not an autopilot. Overweight defensives modestly, perhaps a 10% tilt toward utilities, consumer staples, and healthcare, when the 3-month rolling defensive cyclical spread is above positive 5%.
But keep it temporary.
Right. Treat this strictly as a temporary 3 to 6 month defensive tilt, not a permanent structural reallocation of your foundational capital.
Okay. And in a boom environment?
Second, during boom conditions, when the spread is below negative 5%, selectively add cyclical exposure. However, avoid the expensive growth trap. The framework is strongest when a risk-on regime mathematically aligns with attractive relative valuation.
And what about the tech anomaly we just spent so much time on?
Third, and perhaps most crucially given our discussion of the 2023 tech anomaly, the tech mandate. Investors must stay at least neutral on technology unless earnings momentum explicitly breaks.
So never underweight purely on valuation?
Never underweight a technology sector solely based on historical valuation metrics. You must require clear, verifiable deterioration in their fundamental earnings power before moving below a neutral weighting.
And regarding the transition regimes, when the spread is drifting ambiguously between negative 5% and positive 5%, do not force hard switches.
Because the signal is too noisy?
These are lower conviction periods where the mathematical signal is weak. Hold more cash or simply equal weight your sector exposure rather than forcing a capital allocation call based on statistical noise.
That makes perfect sense. Any final rules?
Finally, demand macroeconomic confirmation before abandoning ship. If purchasing managers' indices, the PMIs that track manufacturing health, fall below 50 for 3 consecutive months, indicating actual undeniable economic contraction, you must use explicit portfolio hedges.
Treasury ETF. Do not rely solely on sector rotation to protect the book during a genuine macroeconomic contraction. Sector tilts cannot survive all shock regimes. Explicit, dedicated hedging is required when the foundation cracks.
Use regime signals, but never let them blind you to structural earnings leadership.
I think that sums it up perfectly.
To summarize our findings, the defensive cyclical spread contains indispensable real-time information about aggregate risk appetite. Ignoring the behavior of institutional capital flows is reckless.
It is, but it has to be contextualized.
However, its true statistical edge lies in risk modulation, telling you when the macroeconomic environment is exceptionally fragile, not in granting permission to abandon structural compounders simply because a relative value screen identifies a cheaper, lower quality alternative.
The tension we have explored today absolutely remains. Navigating the treacherous space between avoiding cyclical value traps on one side and respecting shifting macroeconomic weather on the other requires immense intellectual humility.
The market will relentlessly punish those who treat dynamic quantitative models as inflexible dogma.
It certainly will.
This is the research desk officially signing off.